Good morning and welcome to the FORESIGHT Group Holdings Limited full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Gary Fraser, CFO. Good morning to you, sir.
Good morning, everyone. My name is Gary Fraser and I'm the Chief Executive of FORESIGHT Group. I'm here today to take you through FORESIGHT's annual results for the year ended March 2025. As was said earlier, we'll be taking questions at the end, but please feel free to submit them throughout the course of the day. Okay, and on to the presentation. Okay, we're on to slide 4. Before addressing the group's performance over the last 12 months, I'd like to provide you with a reminder of our strengths. FORESIGHT offers institutional and retail investors with a diverse range of private and listed investment solutions in real assets located in the UK, Europe and Australia. Growth capital for SME businesses across both the UK and Ireland as well. The group delivers high quality earnings with 85 to 90% recurring revenue and over 90% of long duration capital within our LP and evergreen vehicles. This provides considerable revenue visibility each year and underwrites the group's performance. Effectively, every year we start with nearly 90% in terms of knowing what our revenues are going to be. Our boots on the ground approach with 12 offices in the UK and 7 internationally enables us to build deep local relationships that support a strong investment and investor pipeline across all of our strategies. These strategies seek to address the significant investment opportunities within rapidly growing markets, driven by global decarbonisation, increasing electricity consumption, national initiatives to increase energy security, and also by the SME funding gap in the UK and Ireland specifically. And finally, our diverse range of strategies and sources of institutional and retail capital across our 3 divisions of infrastructure, private equity, and FORESIGHT Capital Management provides FORESIGHT Group the resilience through economic cycles in terms of delivering on its targets. Moving on, we've got positive momentum across all of our strategies. So if I take you across all of them, the highly profitable first. So institutional regional private equity, we launched 2 regional private equity vehicles during the period, with raising an additional 112 million. And further consolidating the group's coverage of the UK and Ireland. In terms of UK retail tax efficient products, we had a record fundraising of over 587 million in higher margin retail vehicles. That was a second year of a record fundraising for that specific product set. So we're continuing to build momentum there, and the outlook for 2026 is already good, running ahead of the prior year, considerably ahead. In terms of our highly scalable products, institutional real assets, FEIP 2 is progressing towards the 1.25 billion euro final target, with 485 million commitments approved to date. Again, we're likely to see, a first close on that in the next couple of weeks. So we're making very good progress. In terms of public markets, we had the execution of strategic activity, which increased FCM's AUM by 744 million during the year, collectively adding product diversity, investment experience and scale. That was through the acquisition of the Lion Trust Diversified Real Assets Fund and also Web Asset Management. So in terms of our extended track record of profitable growth, on the right hand side you can see core EBITDA pre-SBP 38% CAGR over the last 5 years. Similarly for AUM, very attractive rates of growth there, with almost trebling over the same period to just over 13 billion as we currently stand. So very good progress today. Our targets, just so that I refresh everyone's memory, is last year we set target of doubling core EBITDA pre-SBP by 2029 to just under 120 million pounds. So step in the right direction in that regard. But what we're trying to do here is create the platform now that we will be able to leverage in the outer years of that 5-year period. So on to the financial results. So, as I said just a second ago, AUM was up 9% at 13.2 billion, up from 12.1 billion a year earlier. FUM, which is the one we earn fees on, was up 14%, up from 8.4 billion a year earlier. And revenue similarly up 9% to 154 million. Recurring annual revenue remained within our target range of 85 to 90% at 87%. And core EBITDA pre-SBP up 5% at 62.2 million. Dividend per share was up a healthy 9% to 24.2p per share, and the final dividend of 16.8p per share will be paid on the 3rd of October. So in terms of AUM, just in terms of the bridge for AUM during the period, so you can see there that gross inflows during the period were 1.3 billion, excuse me. In terms of outflows, we had 0.5 billion, and strategic activity, which is the FCM division that I mentioned earlier, added 0.7 billion, with other movements minus 0.1, taking us to 13.5. When you take into account FX movements, that reduced to 13.2. But just summarizing a few of the key headlines in terms of that movement, we had 587 million of gross retail inflows, again, as I mentioned, a record year. 546 million raised in institutional capital across infrastructure and private equity, and the 744 million earnings accretive strategic activity that we saw in the year. Moving on in terms of the financial summary, a lot of which we've just covered, but just to reiterate, revenue was up 9% at 154 million. Other cost of administrative expenses were up 7%, cost of sales, were up 7%, and core administrative expenses were up 12%. It's probably just worth tackling the addition in cost there, so that we don't skip past it. The costs were really adding additional costs where we thought they were required in terms of adding additional resource in the business. So, some of that was increase in salaries, some of it was additional headcount, some of it was bonuses related to the record year we had in retail fundraising. Where we've targeted additional people, both now and for the future, is in terms of the institutional sales part of the business, where we think we need to add additional resource there, so that on the institutional sales side, we're really driving that forward across our product suite. Additionally, we added additional head resource in terms of automation and IT. Again, we think we can make the business more efficient going forward, which will save us adding additional headcount in the future for some of those more process-related activities. In terms of margin, as a result, margin suffered, and we went from 42% down to 40.4% in terms of net margin, down 1.6 percentage points. We'll recover that during the course of the next 4 years in the run-up to FY29, where I expect to see us at about 45% net margin by that time. So again, we're going to make the progress, but we felt we needed to add additional costs during the current year. And as I mentioned earlier, core EBITDA pre-SBP was up from 59.3 million to 62.2 million. So in terms of revenues, I think you can see the management fees across the business. We've not seen any real contraction in the levels that we're getting. So across the different areas, whether that's institutional real assets or UK retail tax efficient, we're continuing to see moderate growth, or at least no attrition in terms of the levels we're getting. Public markets is fairly constant, and institutional regional private equity remains attractive. Clearly, the key increases in UK retail tax efficient products, which remain one of our higher margin products. Strong fundraising in retail private equity and UK tax efficient products has led the group to mix towards a shift in higher fee rates, which overall has meant that we expect, as that continues, we'll see the margins increase, as I mentioned earlier. In terms of core staff costs, as I mentioned and tackled a little bit earlier on, wage inflation added 3.7 million and headcount added an additional 3.1 million, and bonuses and other added about 0.8 million. So overall, we went from 54.8 million to 62.5 million during the period. So in terms of the drivers for growth, Looking ahead, as we look to double between now and FY29, the key additive parts of the business that we expect to really add in terms of profitability is institutional real assets. So we're looking at FEIP 2 there with the first close upcoming. We're also looking at our Foresight Natural Capital 2, our second fund, which over the measuring period will add about 500 million of AUM. In addition, our ARIF, Australian Renewables Income Fund, is open for further fundraising now, and we expect to add further assets in Australia as well. UK retail tax efficient products, we're targeting a minimum of 600 million a year, but I'd be very disappointed if we don't overachieve on that, given that we raised 587 million in the year just ended. Institutional regional private equity has been very successful over the last 5+ years, raised 2 funds last year, and I would expect to see us raise at least 2 funds a year over the next outturn period. And I think we'll see another Northwest fund raised in the next few weeks. Margin expansion, as I alluded to earlier, as we raise those larger institutional funds, I'd expect margin expansion to increase over the outturn period to FY29, moving up from where we are now, 40.4%, up to the mid-40s during the outturn period. So in terms of each of the different asset classes, we've got institutional real assets. So the key vintages that we're looking at are the Energy Transition Fund, FEIP 2, where we're targeting 1.25 billion euros, up from 851 million euros last time. Our Energy Transition Fund in ARIF in Australia, where we're targeting additional fundraising during that period. And as I mentioned, Foresight Natural Capital, original fund raised just over 250 million sterling, and we're targeting 500 million euros in vintage 2, and that's currently in pre-marketing. In terms of UK retail tax efficient products, that market continues to increase 17% compound annual growth rate. We've seen that market go from 1.2 up to 1.9 billion over the last few years. And our target is to continue raising significant amounts of money from that. Within the business relief segment of that market, during the course of the last year, we became the #1 player. And as I said, in total, including VCTs, we raised 587 million with a target of 600 million per year going forward over the next 4 years. But as I say, I expect us to exceed on those targets going forward. In terms of institutional regional private equity, we've got 12 offices and 15 active regional funds. We're just starting to see second and third vintages of those funds coming through. So as we realize some of the assets from the original funds and we start to see performance fees or carried interest coming through, we're also seeing second and third vintages that are usually, in most cases, higher or raise more money than the previous vintages did. So all in all, we'd expect to continue to raise more funds in the institutional regional private equity segment going forward, which is a particularly attractive part of the business. In terms of market opportunity and outlook, so within energy transition and natural capital, within the UK, although Foresight is a well-known brand within the UK energy transition and natural capital segment, we currently only take about 6% market share, 1% in Europe and about 5% in Australia. So the market is enormous. And as we build out and add additional resource in our institutional sales team, I'd expect us to take more and more market share within each of our 3 core segments. So the market opportunity for us is particularly attractive. Within UK retail tax efficient products, we've seen a CAGR of 14% over the last 5 years within business relief and about 8% within venture capital trusts. We're one of the best performing, if not the best performing in both of those segments. And we've just hit, as I said, #1 within the business relief product segment. So we're expecting to see our take in terms of retail fundraising going forward over the next 4 years to the end of FY29 to be particularly attractive and exceed previously known targets. Within the market opportunity within regional private equity, I'd consider Foresight in the top 2 in terms of regional private equity in the UK, both in terms of performance, but also in terms of size. But within that, we're still only 6% of that market at 2.1 billion. And similarly 6% in Ireland at 0.4 billion. So there's still a lot of market for us to go at. So previously, we might have thought that maybe doubling was, the maximum that we could achieve within these markets. But I think there's much more to go at, not just over the outturn period to FY29, but FY29 and beyond. So I think there's still a lot for us to go at there. And as our brand increases and we develop more relationships with the local government pension schemes, I'd expect us to exceed previous targets as well. Moving on from the markets to capital allocation. Foresight is a very cash generative business. Our key capital allocation objectives, if you like, 60% dividend payout ratio. And as I mentioned earlier, that's 24.2p this year. Up until the recent pop-up in share price, that was over a yield of over 6%, which is very attractive in the current market. Share buybacks, we've committed to investing up to 50 million, I wish 50 billion, 50 million over the next 3 years in share buybacks. And we can already see the impact on that in terms of liquidity within the stock. If I go back a couple of years, average daily liquidity was probably around 40,000 shares. It's now up closer to 225 to 250,000 shares on a daily basis. So we're starting to see the impact in terms of liquidity. And then in terms of M&A, at the moment, while the stock rating is probably between 7 and 8 times EBITDA, it's very difficult to use shares as a currency for M&A. But that doesn't mean we can't do opportunistic M&A when the opportunity arises, where we're seeing when it's accretive. We won't do earnings dilutive acquisitions. So when it's accretive, we can still use shares to do that. But also, we're being cash generative, we're able to use our cash resources to do M&A as well. And you've seen that over the last few months where we did the Web and Lion Trust deals as well. At any point in time, we're probably looking at 4, 5, 6 opportunities. Now, many of those just fall by the wayside. But that said, we're always actively looking at potential, either strategic or opportunistic activities to do some M&A for the business. So, in summary, for current trading, AUM and FUM, this is to just before the end of June because it's pre-today, increased to 13.4 billion and 9.7 billion respectively. There was strong retail fundraising, which more than offset listed market net outflows during the period. And I would say that some of our products are 30 to 40% ahead of where they were in the first quarter last year. Just to make that clear, the first quarter is often the lowest quarter for retail fundraising because it's post the tax year end. We launched a private credit focused business relief product, and early indications are that that can be very attractive for retail investors. FEIP2 and Foresight's existing business relief product completed the joint 210 million acquisition of Harmony Energy Income Trust, which is a public to private transaction that completed over the last few days. And we expect to make very attractive returns from that product. And within our Australian business, we agreed the sale of a major Australian investment in Zenith Energy at a valuation that's materially above the fund's prior holding value for that asset. And I would expect that to deliver performance fees for Foresight as a group, both in the current year, but over the next 3 years. In terms of outlook, we've got strong structural drivers supporting further growth across all of our strategies, which we touched upon earlier. Following our progress in FY25, we remain on track to double core EBITDA pre-SBP in the 5 years to FY29, starting last year. And we remain taking a disciplined and proactive approach to capital allocation returns, materially all free cash to shareholders. But obviously the caveat there is that if we're doing M&A, then we will look at allocating cash as appropriate to M&A. So while we're doing buybacks and we're returning through dividends, we may also look at turning off the buyback tap when we're doing M&A. It really depends on the best use of our cash resources. But as things stand today, the buyback, where we're buying our own shares at about between 7 and 8 times core EBITDA multiple, feels like the best use of cash resources for now. That concludes the formal part of the presentation, and I'll now look to take questions. Thank you very much.
That's great, Gary. Thank you very much for your presentation. What I'll do is I'll just bring your cameras back up at this point. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated on the top right corner of your screen. But just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides, the published Q&A, can be accessed via your investor dashboards. As you can see, we have received questions throughout today's presentation, and Liz, at this point, if I could hand over to you to share the Q&A, that'd be great, and then I'll pick up from you both at the end.
Thanks, Alessandro. Yeah, we've got a couple of questions through, so we'll start off with those ones. But as you said, welcome any more that you may have. If we pick up initially just on those that linking into the outlook, Gary, that you just sort of updated us on, and specifically the new private credit business relief product. So Adam's interested on whether we can expand on the demand signals that we're seeing for that product, and its relative potential to be a flagship offering in future.
Yeah, I mean, so to be clear, we have private credit offering within our existing business product. We've grown that to about 300 million out of about 2 billion in terms of the whole business relief product across across Foresight. So within that, we were limited in how much further we could grow, but there was still demand, not only from the existing companies that we purchased, as trading businesses, but also from additional businesses. And therefore we felt, given those demand signals for more investment within that space, more companies looking for capital, the best thing to do was to take that product and make it an individual business relief product in its own right. So the demand signals were really coming from the existing 300 million plus product set that we had. So we're very confident in terms of the ability of that to be a flagship product in the future. And early indications are that could get off to a really good start for the new product. So very confident in terms of the launch of that product, which happened about a month ago now. And we're starting to see inflows already. And the outlook and pipeline is being built, and the pipeline already looks very attractive. So potentially a flagship product going forward, yes, is the answer.
Thank you, Gary. And then we've had a couple of questions around the Web and Line Trust acquisitions, specifically whether we have a pipeline of similar type acquisitions given the challenges in that active industry. So are there any other opportunities that we think we could look at there? And then equally just linked to that one, are there any other segments or geographies where we see potential bolt-on acquisitions? So specifically anything else in that active space, which we know is structurally challenged? And then equally, is there anything else on different geographies or different segments where we could see bolt-on acquisition?
Yeah, I mean, in this structurally challenged area, there's certainly 2 or 3 that we're currently looking at. I think where you have some of the smaller players who might be continuing to suffer outflows, as the market has seen more generally. There comes a point where you're heading towards or below critical mass, and so there's certainly 2 or 3 that we're actively considering and will continue to look at. In terms of more strategic and geographically, probably Europe is our largest focus at the minute in terms of additional opportunities, and that would principally be in the infrastructure part of the business as opposed to the listed sector.
Thank you. And then tying into that Europe comment a little bit, are there any specific regulatory or capital tailwinds that could make Europe a larger contributor to FUM growth going forward?
I mean, there's 2 probably that spring immediately to mind that we're seeing on the ground, if you like. The first one is certainly energy security. So although, military security has been very much at the forefront over the last week, energy security, I think, post Russia-Ukraine has been a big, governmental tailwind for Foresight in Europe more generally. So we're continuing to see investment. We're continuing to see LPs looking to invest within renewables, within energy transition, within grid networks to build that energy security for the future. So that's certainly been a tailwind. I think the other thing we're seeing is, with some of the volatility in the US, we're starting to see more US type investors looking at the products that we're offering as well. So there's real potential there as well. So I think 2 sort of governmental driven tailwinds there that we're starting to see the benefit of going forwards.
Thank you, Gary. And then moving on to Australia, David comments that we seem to be very positive about renewable energy opportunities in Australia. He also notes that Foresight Solar has been exploring the sale of its solar investments there. And can you maybe just give a bit more clarity on our thoughts in this area and what the opportunity is and what we're most interested in there?
Yeah, I mean, I think we're certainly, we're very bullish in our Australian subsidiary more generally. I think what we've seen recently with the sale of the Zenith Energy to a large international private equity player gives us confidence in terms of the, I would say it's more broad than just renewable energy. I would say it's infrastructure more generally. Some of that being core infrastructure as well as renewable energy infrastructure. So certainly very positive on that. So I think we see more opportunities within the core energy infrastructure part of the business in Australia. I think the other reason behind being so bullish, in addition to what we've seen on the ground with our assets, is we're at 42% or 40% roughly in terms of renewable energy penetration in Australia. And the government target over the next 5 years is to almost double that. And that is going to require about 300 billion Australian dollars to be able to do that. So I think, people have a tendency to leave investment until it absolutely has to be made. But I think we're going to see more and more requirement for that investment to be made in the next 5 years. And I think we're well placed, given that we've got a team of between 50 and 60 in Australia, to take advantage of that investment requirement when it comes.
So in summary, very positive on the Australian opportunity, and then with FSFL, that's really just a fund-specific activity that we need to do as a function of the challenging the markets over here and what that fund needs to do in terms of returning.
Yeah, I think FSFL sales, specifically in terms of the Australian assets or what it's been looking to do, that's more a function of the investment trust malaise that we've seen in the UK and the wider discounts, albeit over the last couple of weeks we've seen discounts narrow by about 10%. That's more to do with recognizing the ability, the need to return cash to shareholders via through a variety of mechanisms. And it's a general push toward, listening to what shareholders and investment trusts are saying and what needs to be done to try and reduce those discounts further. I mean, the only comment I would make is that we're starting to see that happen across the piece. So, Foresight's done 2 public to privates of investment trusts over the last 12 months now. And additionally, on FSFL, we saw the vote for discontinuation fall from mid-20s last year down to early teens. I think it was about 13%. So we're certainly looking at capital allocation, and the signs are positive, I think, in terms of what we've seen in terms of the vote for discontinuation, probably across all of the infrastructure investment trusts. So I would sort of segment what's happening with FSFL against our general positivity in Australia.
Thank you. So just we've got a couple more questions which are sort of more corporate structure in nature. So just reminding the audience that if they do have any further questions, if they could pop those on now, that would be good. So firstly, a question around whether we have any balance sheet exposure to funds and strategies, and if so, how material that might be.
Yeah, our balance sheet exposure is very limited. I mean, we apply when we invest in a lot of the GP LP funds. There's a co-investment requirement. Usually it's between 1% and 2%. Half of that would be invested by the team and half would be invested by Foresight as a corporate. But it's a very small amount. It's low millions in terms of our exposure to the funds.
Thank you. And then just a question around our targets. So if we hit the expected core EBITDA pre-SBP target, would you also expect EPS to track or exceed this, especially as we expect margins to increase?
I would expect EPS to at least track, if not exceed it, over the same outturn period. So, and what we've tried to do with the adjusted EPS, which is slightly different to prior years, is to try and get that to be a closer representation of both profitability, but also cash flows within the business, so that what we're trying to push out in terms of EPS and the 60% dividend payout ratio.
Thank you. And then just specifically on share-based payments and the trajectory there, are you expecting those to increase and potentially dilute shareholder returns over that period?
I mean, share-based payments are pretty much set at 1% per annum. So, and given that we're buying back shares, I would expect the percentage to remain, not the percentage, but the total number to remain the same, if not less, because the amount of buybacks that we're doing is greater than the amount of shares we're issuing under share-based payments. So if anything, I would see shareholders being less diluted, if that makes sense, in terms of their equity percentage than they have been.
Brilliant, thank you. That's all the questions we have currently, Alessandro.
Perfect. That's great. Well, thank you very much for answering those questions from investors. Of course, the company can review the questions submitted today, and we will publish responses on the Investor Meet Company platform. But just before redirecting investors, provide you with their feedback, Gary, could I just ask you for a few closing comments?
Sure. I mean, hopefully, given the questions and what we've discussed today, it gives you a flavour of the confidence that certainly I have in Foresight in terms of our ability to achieve the doubling of core EBITDA by 2029. But also, hopefully, we've drilled down a little bit, at least, into the levers that it's going to help us achieve the doubling over that period of time. I'd also just like to take that, my last words being, thank you for taking the time to listen to me today. Hopefully it was helpful. If there are any other questions that people think about afterwards, please feel free to get in touch. More than happy to answer any questions you have. And I hope you have a good rest of the day. Thank you very much.
That's great. Well, thank you very much for updating investors today. Could I please ask investors not to close the session, as you now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. On behalf of the management team of Foresight Group Holdings Limited, we'd like to thank you for attending today's presentation, and good morning to you all.